throughout this day, a lot of people are going to talk about the specifics, some of the tech, some of the things that are being done to improve financial freedom. And so what I'm going to do to open this up is kind of set the stage for how we got here in the first place. Why do we need financial freedom? Why isn't it already built in to what we have now? And when I was setting out to write Broken Money, the challenging thing for me was figuring out how to open the book, because it's an almost 500-page book about finance. And it's accessible, but how do you get people involved in it? And so what I started out with was tangible examples of just multiple examples of money being broken around the world and how that affects people. And so for this, I'll just pick one example, which I'm using Egypt here. This is Egypt's inflation rate ever since 1958. So decades and decades and decades of inflation. And as you can see, about half the time, they were in double-digit inflation. And you can imagine, if you're going through this process, what it's like. So in addition to your savings always being eroded from you, even your wages are often removed from you. Basically, everybody's on a constant treadmill to try to keep up with the dilution that's happening. And as part of this inflation, what was the cause of it was that if you look at their money supply growth, it was something like 20% per year pretty regularly. So everybody's wages, everybody's savings is on this constant treadmill being taken from them. And in addition to that, of course, it's all entirely surveilled, it's censorable, and they find themselves in a currency monopoly. They don't really have a choice other than to deal with this currency, and that's just what's available to them, and they happen to have been born in one that's troublesome. But this isn't even the worst one. I mean, dozens and dozens of countries have outright hyperinflated during our lifetimes, let alone long ago. We all think of like the Weimar Republic, or we think of extreme examples, but dozens of populated countries have hyperinflated or nearly hyperinflated just within the past couple decades. And so how did we get to this point? How has money kind of gotten this bad, even though in many other ways, in energy and technology, we've gotten so much better, and yet our money system around the world is broken? So when we look at money and how we kind of got to this stage, a lot of it is technology. Over time, technology shapes what we use as money, and then also how we actually move and verify that money. And so it starts out with things like moving up the physical stack in terms of money. So earlier civilizations would use things like shells and grain and livestock as money. But as our technology improved, we found out how to make more of those very quickly. And so we kind of settled toward harder monies to make, silver and gold. And so that was kind of a first kind of technological track for how we came across money. But then the second set of technology that affects that is all the different ways to exchange legal ownership of it, make it more efficient along the way. So we're not relying, for example, on chunks of gold and silver. So technology that we think of as basic today, but that was actually advanced at the time, are things like coinage, paper, bookbinding, the printing press, and analog encryption techniques. These are things that allowed money and exchange to move around more quickly. And when a lot of people think of banking, they think of the Italian city-states as where banking emerged, but it really started even before then. So for example, in the book, I highlight the Hawala system. It was present throughout North Africa, the Middle East, all the way down to India, basically across the whole Silk Road. And the way that would work is that there'd be these Hawaladar money changers, and someone could deposit gold, and they could get basically a receipt, a paper receipt that they could then bring with them and then redeem it for gold in another city based on someone in that network. So it's a trusted network, and of course you need various analog encryption techniques, things to make it so that that paper can't be forged, the Hawaladar can't be tricked by people making more of those types of receipts. So we kind of went through that analog tech track for quite a while, and we built up more and more complicated banking systems and ledgers. But then in more recent decades, we've gotten into the digital side. So the telegraph, the telephone, the internet, digital encryption, and now blockchain. People, especially some of these earlier ones, we don't necessarily think of them as monetary technologies, but they shaped how we use money dramatically. So getting to this chart, this one, I think is, if I were to say what is the most important diagram in finance, it would be this one. And this is from William Stanley Jevons in 1875. And yet it's just as relevant today as it was back then. And the reason I highlight this is this chart was made about 9 years after the telegraph was brought across the Atlantic Ocean. So prior to the long-distance telegraph, Anytime you wanted to send information, you had to go there physically. You couldn't send information any faster than foot, horses, ships. Low bandwidth could go on birds or something, but any sort of high bandwidth information could only go as fast as people could move. But when they built the telegraph, they designed the telegraph in the 1830s, but they didn't widely deploy it until around the 1860s. That changed everything, because now suddenly we could now send information very quickly, even though the physical settlement couldn't be done quickly. And if you can do information quickly, it means you can do transactions quickly. And so that opened up a huge speed gap between transactions and settlements. And the way we've spent the last century and a half solving that speed gap is through centralization, which is what William Stanley Jevons was highlighting. So on the top chart, you have a bunch of different people, A, B, C, D, and E, and they all use the same bank P. So if A wants to send C money, they just tell bank P, debit my account, credit their account. But then, of course, if you have different banks, those banks need to be able to communicate as well. So, for example, if someone in the front row uses a different bank than me, our banks need to be able to coordinate so that I can send you money or you can send me money. And then it gets even more centralized, which is they say, well, every bank can have an account at a central bank in a similar way that every individual has an account at a bank. So instead of banks trying to find individual ways to settle with each other, like through armed delivery or some sort of credit system, they all kind of unify on a standard. And it makes it more efficient, but as you can see, it's now getting kind of dangerously centralized. And if you're either kicked out of the system or the system's used against you, you don't really have much recourse. And then the fourth one was if you have an international situation, so you have different banks, different central banks in different countries, how do they coordinate? And the answer in Jevons' time was that they all basically coordinated through London. They all basically said, well, we're all going to tie into the biggest central bank, the biggest kind of banking area. And so you had basically just 4 layers of centralization. And what I find so fascinating about Jevons when he was describing this was he was both talking about how remarkably efficient it was. He's saying this is so hyper efficient that all these claims for gold can move around, and the gold almost never has to actually move. It's like marvelous. But then he's like, the byproduct of this that it's now levered 20 to 1 in his day. So even a century and a half ago, it was already quite levered. And he's like, we have to remember that if 5% of people come to the bank and get their money out, it's not going to be there, right? And of course, that all blew up decades later in World War I. And so you have this increasing stack of centralization. Every friction is solved through another layer of centralization, and that opens up the possibility for persistent debasement, fraudulent backing, and of course, just a complete surveillance and control stack all the way down. And that allows for the imposition of currency monopolies and basically gives people no recourse if, for whatever reason, they're in a non-functional one, which, as I showed from the first chart, there are many countries around the world that have dysfunctional monetary systems. We're broken into all these different silos. And what's remarkable about Bitcoin is that ever since 2009, this is the first credible technology that can actually start unwinding some of this. So it's not just another layer on the stack. It's not another efficiency layer that allows us to move things around quicker like a fintech. It actually goes back to the heart of the system and asks, can we do this in a more decentralized way? And the way I would describe it is we've had this century and a half speed gap between transactions and settlements, and that was always solved through credit and centralization. And Bitcoin is basically the invention of fast settlements. So finally, we instead of having to move around gold or relying on a centralized ledger, you can actually have a decentralized bearer asset that you can send someone that is a non-reversible transaction. And then that basically allows you to compress that stack of centralization and give people a lot more power, a lot more options. And even though it's 15-year-old technology, it hasn't really hit scale until around the last 5 years or so. Basically, from the beginning, it was a niche collectible. It was a niche like science experiment. But once it became multiple hundreds of billions of dollars worth of value, now over $1 trillion, it's actually starting to become relevant on a macro scale and relevant for a human rights context where people previously could not send money to certain jurisdictions, or if they were debanked, they didn't really have recourse. And now there's technology that allows you to move around money in ways that are efficient, that can be done at scale, that have a sufficient liquidity to actually start affecting people's lives and reversing some of that. And then there's also stable coins as well. So basically someone in a jurisdiction, if they're in a very hyperinflationary, just high inflationary regime, they have choice of money. They can pick Bitcoin, they can pick gold-backed stable coins, dollar-backed stable coins, whatever they want. They have choice now, whereas before they did not have choice. And this is basically something that you don't see a lot of aid organizations talking about. And that's one reason I'm so excited for the work that the HRF does, because they're one of the organizations that saw early on that without financial freedom, you can't really have any type of freedom. Basically, if your activist bank accounts are being closed, if they're highly surveilled, if it's all a very permissioned system, that can all be used against activists or all be used against people who, for whatever reason, are not aligning with the majority. And so this whole system gives us a new playing field, a new alternative system that people can build upon. It's open source. People can collaborate. And we'll see many examples today of things that people built, and they don't have to necessarily communicate with each other because they can communicate over this open shared protocol. And it can kind of reverse a lot of the issues we've been talking about over these few minutes, basically this layered stack of centralization. And so if I were to kind of summarize the path we've gone into ever since the kind of the pre-telegraph and the post-telegraph era. So in the beginning, kind of before the 1870s, before the 1860s, you had both slow transactions and slow settlements, and therefore middlemen were optional. They could provide services, all the way going back to the Hawala system and before that, they could provide services that were helpful for money, but they weren't entirely essential for money. But then, once we entered the kind of the post-1860s, 1870s environment, we got to a period, as I explained, where settlements became, they were still slow, but transactions became very fast. And the danger with that system was that middlemen became far more necessary, because kind of credit was really the only way to kind of bridge that gap between, say, hard money like gold and the ability to move around value and information IOUs in a telecom world. And then ever since 1971, we've actually just kind of dropped the concept of settlement altogether. And so we only have central middlemen. We only have central bank ledgers that kind of defines what our money is. And so it just becomes middlemen all the way down, and we don't really have this concept of settlement anymore other than fiat settlement. And Bitcoin, rather than just being another layer or another way to kind of expand what's already happening, is that it speeds up the fast settlements so that now we go back to a period where middlemen become more optional, they become more thin. Instead of banks existing at the core of the network and controlling the network, they exist now on the periphery of the network. They can provide optional services, but a lot of what we can do can be done with the protocols themselves to make all of this kind of more optional. And that's, in my view, very empowering for people. And so when we take a step back to how is money broken, how do we get to the point we're at now, the way that I would describe it is that because of that huge mismatch between fast transaction speeds and slow settlement speeds and all these kind of layers of centralization to address it, we've ended up in a place of about 160 different currencies. So every currency in the world, except for the dollar and a handful of other reserve currencies, can basically be thought of as arcade tokens or casino chips. Currencies lack moneyness, the property of moneyness outside of their borders. So people in those jurisdictions, they have this currency monopoly imposed upon them, and if they bring their money elsewhere in the world, it's not really useful. So for example, if I bring Egyptian pounds back to where I live in New Jersey, it's actually very, very hard to get those Egyptian pounds off my hands for any sort of goods or services or even for another type of money. It's actually arguably harder in some cases to convert that than it would a popular casino chip. It's got about the same amount of liquidity when it's outside of its context. And then even a wealthy country like Norway, for example, it's a similar thing. If I have Norwegian currency in Egypt or Norwegian currency in the United States, it's a very small, unsaleable money, even though it's a wealthy nation. And so we've kind of broken our currency up into all these different pieces. And we kind of think of this as normal now. We don't, like a lot of policymakers, a lot of people, they just kind of think this is how it works. Every country has a currency, or at least most countries have a currency, and it's normal for them to all be 160 different floating or pegged different exchange rates. But when we go back in history, that wasn't always the case. They used shared money like gold and silver. They had more interconnectedness between them. And that's been a property that's been lacking this whole time. And the way that that's controlled is basically there's only two main ways to get value in or out of a country. One is ports of entry, but of course ports of entry are very controlled, very surveilled, and it's hard or risky to bring large amounts of value, especially outside of very restrictive areas. So that's one measure of control that keeps people trapped in. There's basically limited value density going through a port of entry. And the other one is a bank wire. You can, of course, send money digitally, but the problem is those are also very surveilled, very controlled. The country can basically decide who can access, for example, a dollar bank account, who can only access their local currency account, and they can set artificial exchange rates. So we'll often see, for example, there will be a country where the black market rate or the street rate is one exchange rate. That's kind of the real liquid exchange rate. But then there's like a fake exchange rate that when you go through the wire system, they impose basically what they think the currency should be worth. And they kind of put themselves in the middle of that. If they let the transaction go through it at all, it could be sanctioned, it could be blocked for any number of reasons. And so people find them stuck in those silos with very little recourse to do anything about it, either about the inflation component or about the just surveillance and control component and the ability to kind of just move their own portable capital to where they want it to be. But with this new technology, which again, it's been around for, Bitcoin's been around for 15 years and stablecoins have been around for 10 years, but only in recent years has their liquidity gotten sufficient that this is actually becoming a very powerful tool for people around the world. And so now, when you go through a port of entry, there's technically infinite value density available, and that is something that is frightening for some policymakers and frightening for some people, but it's also something that when you think about how important that can be in the right context, that can be life-saving. So, for example, as Americans, some of us might not think, why is that a valuable feature? But anyone who's fled Venezuela or wanted to move from Lebanon or move from any kind of country that otherwise has money systems having an issue or authoritarianism, whatever the reason might be, there's actually ways to convert their value and bring them with them rather than kind of leaving most of their value at home. And then, of course, at the top there, these can all go around centralized bank wires. So instead of kind of going through their banking system, this can now go to people peer-to-peer, to at least anyone who has some semblance of an internet connection or can access this in some way. And so, for example, if I wanted to pay a Nigerian graphic designer, instead of going through her local currency and local banks and fake exchange rates, she can ask for whatever type of money she wants. She can ask for Bitcoin, she can ask for dollar stable coins, and as long as, for example, she can show me a QR code on a video call or send me some sort of payment string with a DM or an email or basically any way of communicating, then I'm able to send her the value that she wants and that she has control over and can bring it with her if she leaves or she can use it there. And basically there's more power between individuals and between peers. And I think that basically, especially in macroeconomic circles, which is where I focus a lot of my kind of broader investing work on, this still remains fairly, a lot of them view it as trivial. They still kind of, I think, are stuck in a mindset from 5 or 10 years ago where this is still fairly small, and I don't really think of it as actually having a large impact for non-techies or non-niche people. But the size that this kind of ability is getting now, the liquidity and the security of systems like Bitcoin, is actually pretty life-changing. And so I'm really glad to see that HRF has been at the forefront of kind of bringing this to a broader audience, a human rights audience, sometimes a non-technical audience, and basically saying that there are tools now that were not available for decades that are now becoming available for people all around the world to kind of have more empowerment in whatever jurisdiction they happen to be in. For the rest of this day, there will be a lot of people kind of going over all the things they're building, all the things that are making this more and more efficient every year that goes by. So thank you.